this video, I'm going to share ways of increasing your credit score so that you get a much lower interest rate, a much better deal for mortgages, auto loans, and etc. So let's get started. So the score is a bit different from the States since it goes from 300 to 900 compared to 300 to 850, but everything else is the same. So your payment history, your types of credits, credit history, credit utilization, and your hard increase. Now, what's a good credit score? So according to Credit Karma, a good credit score would be from 650 to 719, and it'll be considered good to the lenders, but you won't be getting the lowest interest rate possible. If your score is from 720 to 799, then your credit score is really good, and that means you're getting the lowest interest rates possible. If your score is between 8 to 900, then congratulations, since you pretty much have a perfect credit score, but obviously you won't be getting much lower interest rates compared to if you were in the 760 range. Once your credit score is above 760, it's not going to make much of a difference compared to if your credit score is above 800 in terms of interest rates, since already you're getting pretty much the lowest interest rates possible, and already to the lender reliable in terms of paying back your debt at the end of each month. And if your credit score is above 800, then it's for bragging rights, saying that you're pretty much perfect in terms of paying back your debt at the end of each month. If your score is below 650, then you're pretty much riskier to the lender, since they think that you might default on the loan, so they're going to charge you a much hefty interest rate. So it's going to be much more difficult to obtain a mortgage, auto loan, and etc. So you need to work on fixing your credit score if your credit score is below 650. But also, one thing to note, lenders might not just use your credit history, but they might also use your income, your debt to income ratio, capital, and etc. Also, lenders may be using a different credit scoring model. So Credit Karma and Borrowwell, they might be using a different credit scoring model compared to TransUnion, Experian, and Equifax. The first step for improving your credit score would be by checking your credit report for any errors on your report that could affect your credit score. In Canada, there are two main credit bureaus that give your credit score annually for free, such as TransUnion and Equifax. If you check more than once for your credit report from TransUnion and Equifax, then you might have to pay for it. I suggest using free services such as Credit Karma and Borrowwell, which report your credit score from TransUnion and Equifax. You can check your score as many times as you want from Credit Karma and Borrowwell without any hard increase, because it uses something called soft increase, and also it's free, so you can check as many times as you want and you won't have to pay for it. When you get your credit report, you can check to see if there's any errors on your report that can negatively affect your score. An example of a mistake would be if there's a missed payment on your credit report, but you made the payment on time, so that would be an error. So you should dispute that error on your report so that it will stop affecting your score. Another example would be when you didn't apply for a new line of credit, but on the report it mentioned that you applied for a new line of credit, and that would create a hard inquiry. And if you never opened another line of credit, then you should dispute that so it stops affecting your score. By removing any unwanted errors on your report, you can grow your score the fastest. The second tip for improving credit score would be by calling the bank to get your late payment removed. So your payment history accounts for 35% of your score, so it's very important that you make a payment on time. And if you don't make a payment on time, it would negatively affect your score by a lot. So make sure you make the full payment at the end of each month. If you had a late payment and you forgot about the payment date, what I suggest is by calling the bank and pleading your case, and the chances of your late payment being removed will depend on how late your payment is and how much you still owe to the bank. And I suggest having auto pay turned on so that you never forget to miss a payment on time. If you know you might be late on a payment, I suggest letting the bank know in advance so they give you extra time to make the payment. The third tip for improving credit score would be by having a low credit utilization. So credit utilization counts for 30% of your score, so it's essential that you keep a good credit utilization. So let's say, for example, you have a $1,000 credit limit and you spend $700. It's a 70% credit utilization, and that's really bad since you don't want anything above 30% on the statement date. If your credit utilization is above 30%, then it's going to negatively affect your credit score. Another example is if your credit limit is $10,000 and you spend the same $700, then it's a 7% credit utilization, and that's really good. As long as your credit utilization is below 30%, then you're doing really good for your credit score. I suggest keeping a credit utilization between 1 to 9% to grow your score the fastest. There are additional ways of further reducing your credit utilization just by calling the bank and asking for a credit limit increase. So when you ask for a credit limit increase every 6 to 12 months, your total credit utilization decreases as long as your spending doesn't increase. So let's say, for example, you have a $1,000 credit limit and you spend $500. So it's a 50% credit utilization, and that's not really good. But now you get a credit limit increase for $2,000 and you spend the same $500. Now it's a 25% credit utilization, and that's much better than 50%, and it's below the 30% needed to improve your credit score. So when you're able to keep your spending the same and your credit limit increases, then your overall credit utilization drops. The other way is if you have a considerable expense coming up, you can make a bit of a payment upfront so that your credit balance becomes negative, meaning the bank owes you money, and you can make the rest of the purchase on the card so that your balance isn't a bit too high. So that would help you keep a low credit utilization and it wouldn't go above 30% depending on your purchase. The fourth tip for improving your credit score would be by opening another credit card. By opening another credit card, you increase your total credit limit, and from that, your total credit utilization drops. So let's say, for example, you have a $5,000 credit limit and you spend $5,000. So you've maxed the card, which is really bad. But now you get approved for another credit card for $5,000. So now your total credit limit is $10,000, and $5,000 divided by 10,000, so it's a 50% credit utilization, which is much better than a 100% credit utilization on your first card. But only open another credit card if you're responsible with credit cards and you're able to make the full payment at the end of each month. And yes, by opening another credit card, you get a hard inquiry on your credit report, but it's going to stop affecting your score after 1 year, and it drops off your credit report after 2 years. The fifth tip for improving your credit score would be by opening a secured credit card. A secured credit card is a great way of building your credit history and building back your credit score, since it works just like a credit card. The difference is that you give a deposit to the lender, so that means that if you default on the payment for your secured credit card, the lender is going to take that amount and you won't be getting that back. The deposit is refundable and it's typically your credit limit. For example, when applying for a secured credit card, you get approved for a $500 credit limit. That means you deposit $500, and in the event that you don't pay it back, they take the $500 deposit away from you. But as long as you make the payment at the end of each month for a couple of months, you'll get the $500 back and you'll typically get approved for another credit card. Everything else is the same as a credit card, so as long as you make the payment at the end of each month, it gets reported to the credit bureaus, so your credit history grows and your credit score grows. And I'll make a video on secure credit cards in the future so that you can improve your credit score if your credit score is already bad or you need a credit. So stay tuned. The sixth tip is making payments on time, since on-time payments accounts for 35% of your score. When you make on-time payments at the end of each month, it gets reported to the credit bureaus, which will positively affect your score. But if it becomes a late payment, it will negatively affect your score, and it stays in a report for up to 7 years. So you don't want to be missing your payment, since it will severely damage your score. If you can't make the full payment, at least make the minimum payment so that your score stays intact while you can pay off the remaining debt. The seventh tip is not to close your oldest credit account, since your credit history accounts for 15% of your score. The longer you've had credit for, the better your score is, since the lenders can see how many on-time payments you made in the past, and the longer your credit history is, the better. Suppose you have a no annual fee card and you don't find yourself using it that often. What I suggest is putting small expenses on the card and paying it off at the end of each month so that the lender doesn't close your account, since you have no activity on the card. And as long as you make expenses at each month and you make payments, your account is open and keep building your credit history. If you have an annual fee card and you think the annual fee is not worth it anymore and you don't find yourself using it, what I suggest is by calling the bank and asking if they could downgrade your card while transferring your credit history. Also, when you close a credit card, you decrease your total credit limit, resulting in a higher credit utilization, which will drop your score. The eighth tip is to have multiple types of credits. So types of credits accounts for 10% of your score, so it won't affect your score by too much. Types of credits means instead of just having a credit card, you have a mortgage, auto loan, student loan, personal loan, and etc. And when you have these kind of loans, it tells the lender that you're able to make these kind of payments at the end of each month. The final factor for improving credit score is having minimal credit increase. So credit increase accounts for 10% of your credit score. So the more credit increase you have, the more riskier you are to lenders, since they're asking why you need this much credit in a short period of time. So the fewer credit increase you have, the better it is for your score. And harder increase could stay in your report for up to 2 years, but it stops affecting your credit score after 1 year. If you check free services such as Credit Karma and Borrowwell, there's no hard increase, since they use soft increase, which is just an estimation of your credit score. So you can check your credit score as many times as you want on Credit Karma and Borrowwell without affecting your credit score. You should apply for a new line of credit when you absolutely need it or for the offers, but you shouldn't be doing it every month. You should be doing it every couple of months. And there are some credit builder programs such as Coho that just open a line of credit for you so that you can improve your credit score over the coming months. And I'll make a video on credit builder programs in the future. So that's the end of the video. I hope you learned something new and you can use the tips in this video to improve your credit score. If you liked the video, leave a comment and like below, and you can follow my socials in the description below, and I'll see you guys in the next one. Peace.